Work hard, play hard, homeboy, everybody ain't calling out. Got a mouthpiece from the southeast, if you want scrap, stall him out. If you don't know what I'm talking about, then I feel good, man, I'm balling out. I'm a rich man with a rich fam, Christ bars got me out of mama house. And I bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace. Big God, big grace. Big God, big grace. Big God, big grace. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.
What it do, y'all? It's your partner looking old, so fresh, cold, clean. You see that thing, take that picture for your mama and them, and holler at your partner. Welcome for another edition of the Countermove podcast. Forgive me, guys. I'm a little bit under the weather. I've been struggling with a little bit of cold, but it's all good. I still look better than you. It's all good, baby. Let's move forward. Y'all, again, this show is all about taking what's going on in society, and our society from an economic standpoint or social standpoint, looking at it, leaning in and reasoning together, and prescribing a solution. So again, if you are looking for a debate, do me a favor, hit that X button real fast and get up out. But if you could, guys, if you like what you're hearing, guys, share, and click on that like button. That help us out with the algorithm. So, guys, let's move forward real fast, y'all. Let's jump into this topic for today, y'all. All right. I posted a video on Instagram and other platforms, really on Instagram, and it went kind of viral, damn near viral. It's been viewed over 122,000 times, thousands upon thousands of likes, and hundreds of comments, things of that nature, which is pretty cool. And it was about this topic here. It was about what actually happened with SVB Bank and Signature Bank. It was a comment that was actually made by our President Biden. And the question was, did President Biden nationalize the banking system? For what he said today, and actually what he said early on this week. And I said, wow. And when I actually posted a video, guys, it just went bonkers. And so people asked me that question, like, man, what in the world? I had different answers when it came to this question, but it was hinting at what he actually said. And it really came from a comment that a Shark Tank investor actually said. But before we dive into what the Shark Tank investor said, let's go ahead and see what President Biden actually said, guys, so we can lean in and reason together. So here's what President Biden actually said, and we're going to respond. Here we go.
Before I leave for California, I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank.
Okay.
Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Mm-hmm. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills.
Right there is where a lot of people are saying, wait a minute, 90% of the deposits in Silicon Valley Bank were over $250,000. The FDIC only insured up to $250,000. 90% of the deposits were over that amount. So if that's the case, you kind of really kind of violated that cap. And so let's keep going because there's more after this as well.
And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, It took control of Signature Bank's assets.
So the FDIC is involved. Okay.
Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will, this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second.
So let's stop right there, guys, because he goes on for a little bit longer. But come back to me real quickly here. Okay, let's unpack a little bit what he's saying there. Okay, number one, the FDIC is involved. So therefore, the $250,000 cap is actually there because that's on every single bank door. When you walk in, you see that everywhere in the bank. Okay, a cap of $250,000. Okay, now it's time for us to really examine the depositors at Silicon Valley Bank and Signature Bank. We're really Silicon Valley Bank. 90% of them, between 80 and 90% of those deposits were over $250,000. Now, you heard the president said all. That is single depositors or family depositors or personal depositors, and also small businesses. Okay, he literally came out of his mouth. He said everyone will be made whole. Now, here's the one thing that they did say that I did not agree with, and I understand why he did that. They did that to kind of stoke the fears that could come from what was going on in the market. So I understand why they did it, but you violated the FDIC cap there. So because of that, people are saying him doing that, you're nationalizing the banks. Okay, you'll see in the second, and you'll begin to see this rhetoric. So that's the issue. Number two, he says no taxpayer will be on the hook for this. That's actually false, because he pointed toward actually banks are going to pay fees to go back into the FDIC. Yeah, I hear that. So banks will pay this fee, but they're going to pass that fee on to the consumer. So you are going to actually pay that fee. No business just eats a fee. They pass the fees on to the consumer. So that's actually false what he said there. Very simple thing to do. All right. So all they're going to do, they're going to pass that fee on to the consumer. Very simple. So that part of what President Biden said was not true. Okay. But again, I digress. Now, who actually began to actually talk about this nationalization of the banking system? Well, it was the Shark Tank investor, Kevin O'Leary. Let's go ahead and see what he actually had to say about all of this real quickly and see what he said about this. And you're going to see how his reaction. Let's see exactly what he said. He was on Fox Business. Here we go. Let's see what he says.
Who better to go to than Shark Tank investor himself, Kevin O'Leary. Kevin, good to have you back. Thank you.
Thank you. Great to be here.
What is real? What was going on yesterday or what's going on today?
Combination of both. Right now, the narrative with investors in the banking sector is how punitive is this going to be in new regulations? Let's take the regionals first. There's going to be problems ahead here because, frankly, I don't think just guaranteeing deposits is enough to keep everybody with all of their money in just a regional bank. There's going to be diversification. Even in our own portfolio, we have now moved our assets across 5 different financial institutions. I don't care anymore to take risk and concentrated risk, and I think others will do the same. That's problem number one. Number two, if you're a regional bank, I think there's going to be all kinds of new regulations that keep you more liquid in the short term, which means you can't deploy that capital to make returns for shareholders. And then there's this bigger question, which I think is going to weigh on the entire sector. What did we just do? Did we just nationalize the banking system? Because
he's the one that brought it up. Now, why is he saying this? Let's listen.
If there's no risk at all for any depositor of any size, what stops banking managers who are just compensated on equity from just going crazy and doing things that are going to be very extended in behavior to try and jack up the stock price because they have no risk?
Exactly. There's no consequence for the decision making. So what he's saying is if President Biden is uncapping what's going on with the FDIC in every depository, whether it be a personal checking account or a business checking account, 250,000 and above, what he's actually saying is that any banker can then what they do is they can just make any willy-nilly type of investment in the market without any type of consequence. That's an actual logical point. Let's get going.
And you always got idiot managers, the black swan types like that was at the Silicon Valley Bank that did
Right.
stupid things. We have more of those black swans swimming in the lake. We don't know where they are. So I think we basically have to make a decision, and I think this is something every investor is thinking about, is maybe this sector, we've got 11 sectors in the economy. This sector services all other 10. Maybe it's just a utility that's going to be way over-regulated and make really lousy returns for shareholders going forward. And I think that's the debate going forward.
So that is what Kevin O'Leary brought that up. He's the one that brought this up. He talked about this being an issue, and is a logical type of response. Because I agree with him on this a little bit. He's actually saying is there's no consequence for bad decision making from these bank investment managers. There's none, because in their minds, the Fed is just bail them out. Now, what does nationalization mean of a bank system? What that actually means is the government basically takes over the banking system. You have a certain number of banks, let's say 4, all right? And then those 4 report into the government, and the government controls the entire system. That's all nationalization means. It just means government control banking. That's all it means. That's it. And I can see how Kevin O'Leary is actually saying this. Now, let's bring in another investor, okay? Again, notice I'm using investors, not politicians. Okay, I'm using those boots on the ground, actively in the market. Okay, real world case study experience. All right, let's go to another investor that was pretty good. And again, Kevin brought up some phenomenal points. I'm agreeing with him 100%. Let's bring another investor. Before we go here, another investor began talking about this. Come back to me real fast, guys. Another investor that came to this. It was Robert Kiyosaki. Everybody in the mama, if you don't know who he is, Robert Kiyosaki, just go to, he wrote the book Rich Dad Poor Dad. He began talking about what was going on. And I want you guys to hear exactly who he said that's going to be the next in trouble. I want you guys to hear what he's talking about. Listen intently to what Robert is saying, okay? Listen intently. Here we go. Let's go back to Robert. Here we go. Boom. All right, here we go.
Has been sneaking back into stocks, but it's really been a remarkable story into the precious metals and a lot of hard commodities. Gold, for example, up north of 2 1/3%. Look at silver up almost 7%. Copper doing quite well as well. Don't say Robert Kiyosaki wasn't telling you that this was a good haven in these dicey times. He said that there's instability everywhere. It's panning out today, certainly in the banking sector. For how long is anyone's guess. But the rich dad, poor dad, cottage industry, as I like to call him, kind enough to join us right now. Robert, all those investments are doing quite nicely. Now, a lot of it could be a knee-jerk concern about the stability of the banking system and doubts about where it goes. Safe haven to park cash. What do you think, and how long does it last?
Well, the problem is, as you know, for years it kept dropping interest rates, and now Powell's raising it.
Yeah.
The real problem is the bond market's crashing. And
listen, he said the bond market is crashing. That's key. Listen.
And the bond market is systemic, as you know. I mean, I'm concerned about IRAs, pension plans, and all that. So,
you have a 401k, IRA, Roth IRA, 403b. He's talking to you.
this is more than it's. I mean, I'm concerned, should I say? And thank you for all these years letting me come on your program and say buy silver, buy gold, because when I first started coming on, I think this was $3 and this was $50, and now it's $2,000.
Wow!
And it didn't get any bigger, Neil. Still,
no, it did not get any bigger. But you know what's interesting today, Robert? If you look at it, it might be just a sort of a coincidental blip. All are rising. bond prices rising, yields collapsing. A 10-year note, for example, that was over 4% last week is around 3.45% today when I last looked. So bonds doing well, stocks holding up fairly well, bank stocks off their lows, metals doing just fine. That can't continue indefinitely. So what wins out?
Now, the thing that I see is that the Fed and the FDIC are signaling hyperinflation.
We listen to why he's saying it. Hyperinflation. Here we go.
Which makes gold and silver even better because this thing here is trash. They're going to print more and more of this fake money. And that's what the Fed and the FDIC is signaling. We're going to print as much of this as possible to keep the crash from accelerating.
That's correct.
But they're the guys who are causing it.
So what he's saying is all of the excess printing, all right, is what's causing all of this problem. That is a Congress issue, legislative branch, and a Fed issue, central banking issue. Both of them are causing this problem, right?
So in other words, with the Federal Reserve now saying essentially we're going to be a backstop, to say nothing of the U.S. government, for all these institutions in trouble, now guaranteeing deposits for those with way more than $250,000 at a bank, 3 different banks right now. You think that will be inflationary, and you think the pause that some are expecting on the part of the Federal Reserve on raising rates will only exacerbate this?
Well, they have to bail out now, which is not quite legal anymore. But as I said, they're going to print more and more of this stuff, and it makes this stuff gold. And I think this is the best investment of all is silver, because every Tomahawk missile has 30 pounds of silver in it.
That's
Every
correct.
time they push that missile button, 30 pounds of silver disappears. So we're in serious trouble. And the Fed and the FDIC are signaling we're going to do whatever it takes, and that means print more of this stuff here. And this.
And he's right, guys. I actually have silver bars. He's right, 100%. Yep, he is 100% spot on, guys. Listen to what he's saying.
Stepping back from what you like about metals and putting your money in a place that can sort of counter what we're seeing. What are you seeing in terms of inflation? Now, the Federal Reserve's been busy now. A year ago, Friday, when they started raising interest rates, going from 0 to close to 5%, where we are now on the federal funds, the overnight bank lending rate. Do you see that paused indefinitely? Do you see any possibility they reverse action? Or what happens now? I mean, taking a look at the whole, the whole kettle.
Well, let me say it again. The problem is the bond market. And my prediction, I called Lehman Brothers years ago, and I think the next bank to go is Credit Suisse.
And guys,
and if that happens, Japan
because of its exposure to a lot of this.
Yes, because the bond market is crashing. All those bonds. Let's say you're getting paid 5% for a bond, and it goes to 10%. The 5% bond crashes.
Yes.
And the bond market is much bigger than the stock market, as we know.
Yes, it is.
So
Absolutely.
the Fed is the problem, and they're what they say, the firemen and the arson.
So guys, he's spot on, because come back to me real quickly. Then we go back to Robert real quickly, guys. Is he's spot on, because later on that week, Credit Suisse actually had to get bailed out. So he's making his prediction before Credit Suisse actually will begin to fail. So he's making his prediction before that time frame. So he's spot on. Let's go back to him. He's almost done, guys. Stick with me. Here we go.
You know what's weird about this jolt, Robert? I want to get your thoughts on it. This bank, Silicon Valley Bank, they could talk about poor management. I know a lot has been said about that. But more than half their overall portfolio was in U.S. Treasuries, Treasury notes and bonds. Certainly not mortgage-backed derivatives, certainly not crappy mortgage-backed derivatives sold in separate pools to unwilling. And
notice he didn't say mortgage-backed securities like happened in 2008. He's talking about bonds. Bonds is what's tanking, guys. Bonds is. All right? Here we go.
and unknowing investors. So they were doing something that seems on paper to have been the right thing, the conservative thing. The irony was that they were buying a lot of this when rates are at zero, prices were a lot higher for Treasury notes and bonds, and when they had to unload some money, they were underwater.
That's correct.
So you can't win in that environment.
You can't.
No, and that's why I said the biggest problem, as you know, is the bond market, which is the biggest market in the world. And all the countries of the world are in U.S. bills, T-bills and T-bonds. And we had the BRICS nations coming up, and they hate us, and they might switch to the Chinese gold, yuan. So we're in serious trouble. U.S. dollar is losing its hegemony in the world right now. So, and they're going to print more and more and more of this, trying to keep this thing from sinking.
Listen.
So that's why.
But they've been doing that. But that's been going on for years, right, Robert? I mean, we have these huge days like this, and you're quite right to note it's a clear phenomenon today. But we've had these punctuating our history over the last 20 plus years. What makes this go round different?
Because our debt to GDP is over 130, and every time they raise those interest rates, America's taxpayer gets hammered. And my concern is the pensions are in trouble because they're loaded with bonds also. And my generation, the boomers, we're starting to retire. So this is the perfect storm in many ways. So like I said again, I think the Fed and the FDIC signaled they're going to print again, which makes stocks good. But this little silver coin here is still the best. It's $35, So I reckon anybody can afford $35, and I'm concerned about Credit Suisse.
Interesting. I have heard that before. If you get a big bank that has this exposure, and Credit Suisse does have a lot of conservative treasury.
So, guys, he is mentioning about, come back to me real quickly here, guys. He's mentioning that banks that have a lot of these bonds or these pension funds, the 401ks, the IRAs, Roth IRAs, 403bs, have a lot of these bonds. They're in some trouble. He's concerned about that. And I agree. And you can say that because the very same bonds that Credit Suisse actually has, and also Silicon Valley Bank, these pensions may have. They may have these same bonds, guys. And we just heard the bond market is the biggest market in the world, right? Here we go. So, guys, how did this actually happen? Okay, let's go. How did this actually happen? And what's going on behind the scenes? All right. So, guys, let's bring in our old guys from Valuetainment, and they're going to kind of unpack this a little bit more, guys. Thanks for hanging with me. No problem with it at all. I know not as fiery as I normally am, but it's all good. Let's see exactly what actually happened, guys. And how did this bank failure happen, and see what's going on behind the scenes. Here we go. Let's go.
Bank collapses and second biggest U.S. bank failure ever. This is an independent story. California-based Silicon Valley Bank was seized by regulators on Friday, making it the second biggest bank failure in U.S. history since 2008 collapse of WAMU, which had $307 billion in assets when it was shuttered on 25th of September 2008, 10 days after Lehman Brothers failed. Silicon Valley Bank failed after depositors, mostly technology workers and venture capital-backed companies, started withdrawing their money, creating a run on the bank. The bank had approximately $209 billion in total assets and about $175 billion in total deposits. As of 31st December of 2022, this is Silicon Valley Bank. And it was unclear how many of its deposits were above $250,000 insured limit guaranteed by FDIC.
93%.
However, 93%, right. However, there is little chance of contagion in the banking sector as major banks have sufficient capital to avoid a similar situation. So this has scared a lot of people. I'll go to you first, Barry. Based on what we know, what was your reaction? Were you surprised? And then we'll get into how we feel about the way they're handling it, whether it's Yellen, Biden, because he gave a speech today.
So, okay, there's a lot to unpack here, so I'll just try and be quick here. So this bank had problems because in 2008, under the Dodd-Frank, they were allowed to invest in assets. Now, it wasn't a bad decision necessarily to invest in these assets, but what happened was that they were yielding on $82 billion worth of investments around 2%.
Wow.
Now, it's okay because if you're paying your depositors very little, you can make some spread there. But as you know, when somebody deposits money in your bank, you don't have all those assets on hand. You keep
correct.
roughly 10%. The rest you lend out to try and make the arbitrage, to try and make the spread. That's how banks
Let's call fractional reserve lending. Let's go.
make money. The problem is that a lot of these investments were now underwater.
Wow.
You see, when you invest in a lot of the bonds that they invested in, they invested in mortgage-backed securities. So a 3% mortgage equals a 2% coupon because everybody takes a piece. So those 2% coupons, I'm getting 2%. That's okay if I'm paying a half of 1%. I'm making money on it, okay?
Yeah.
However, what starts to happen is as the Fed has maniacally raised rates without thinking about the consequences, they're not very good at unintended consequences.
Yeah.
They now give people alternatives to move their money. So now
Listen.
you can move your money to a short-term 6-month treasury and get 5%. So
Yes.
people start withdrawing money. Tech companies were doing a little bit more poorly, as we know.
Yeah.
They start having less capital. There's less money going in.
Yep.
So what happens is that the bank now has to make up this money.
That's correct.
Where do they get it from? They have to now sell assets. Here's
Listen.
the real craziness of it. They had on their books $12 billion positive.
Listen.
But it really wasn't. Because
Wow.
once you started looking deep, what they had was invested in these bonds that were now underwater.
Yes.
Under Dodd-Frank, these are considered now to be no-risk assets.
Wow.
So
listen to what he just said. Dodd-Frank, those underwater assets were considered non-risk investments. Listen.
you do not have to report under Dodd-Frank unrealized losses.
That is sick. That's terrible.
They had 15 billion in unrealized losses. This was not a solvent bank. They were 3 billion unsolvent.
That's right.
As at the end of last year, which is why the CEO was selling stock, which is why you had insiders getting paid bonuses up front and early.
So they knew what was going on because of the fact that the CEO and people were selling stock earlier, and also you actually had individuals making some commissions up front while they were selling as well because they knew what was going on behind the scenes. Let's keep going.
Now they start to get exposed because Jim Cramer, an amazing 5 weeks ago, touts this as the stock you got to buy.
Trash.
Okay, it is.
Stop it. Jim Cramer was out there
Look
doing
at
his thing again.
February. I swear to you,
Wait, no,
February.
pull up the video.
We got the video.
Is this the same Jim Cramer that compared Sam Bankman-Fried to Rockefeller or
exactly.
to Andrew Carnegie?
There's actually an ETF which is a contrary to Jim Cramer. But anyway, really on point here.
I'm sending it to you just so you know.
So Jim Cramer on February 8th talks about how the stock's undervalued, how it has room to run, is his quote. It was at $320.
Here's, watch this.
Listen,
watch this.
Listen.
Yeah.
Jim
Put
Cramer,
the audio so we can
CNBC,
hear it.
listen.
It's the Jim Cramer dead cat bounce.
Watch this.
Year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yeah, some of them come back here, but the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's so cheap. Now, you have to remember that a stock that falls
just a few weeks ago.
66%, like
February
SVB
8th.
did last year,
Trash.
well, it takes it
Trash.
a lot more to
Look at this.
recover. After losing 2/3 of your value,
Trash.
you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it.
That's crazy.
I think it's also a good example of why these bounce back moves
ridiculous,
might
man.
be far from
It's
over.
ridiculous.
These stocks should have more room to run, especially if you think they were driven
trash.
down to artificially low levels.
That's
By
crazy.
tax law
Trash.
selling,
Yes, it's
artificial
crazy.
dumping.
But
Trash.
Patrick,
We should find the chart on this.
But here's
This is a classic. This is SVB. It's
Trash.
a classic dead cat bounce.
Garbage.
he's right. But here's why this is significant.
Yeah.
Because this draws attention to SVB.
Listen,
Now,
listen.
whether you want to think of it as investment or not, now people start digging in.
Yes.
And as people dig in, what do they see? They see this 15 billion in unrealized losses that they didn't have to report. But now that you dig in, and what do they start telling their clients?
Get
They
your
start
money
telling
out.
your clients, hey, you know what? This bank is vulnerable.
Yep.
I'd probably take my money out of there.
Yes, sir.
And as deposits start now cascading out of there,
Yes.
this is where they have to raise money.
Yes.
They go to raise 21 billion, and they do because they have to. But how do they do it? They sell some of their assets.
Listen.
Now, When you sell those 21 billion, they cherry picked them.
Yes.
Only 2 billion in losses.
Yes.
But now you have to realize those losses.
Yes, sir.
Right? So when people look under the hood, they say there's another 13 billion in unrealized losses. People start pulling out money in droves.
Yes,
they can't borrow money. The shorts are attacking the stock. They can't issue stock. And this is how it happens so quickly.
So let me just give some of the stats. If you can show have this here.
So guys, come back to me real fast. That was a phenomenal breakdown about how it actually happened. Guys, it's a lot of mismanagement there. That's exactly this is how all that actually happened, right? When they trying to hide what was going on, they were forced to sell, and that sale, right, forced them to show those losses. Brilliant breakdown. That's how that actually happened. But then you had Kramer on CNBC 5 weeks ago talking about this was a great stock to buy. Trash, garbage, trash. They said that's crazy. That's crazy. And also, guys, the chief, the chief compliance officer, and I may be using the wrong C-suite acronyms there or name, that had a chief risk officer, had not been there for 4 weeks, had been let go 4 weeks ago. But that's when she stopped getting paid. Right? That's when she stopped getting paid, was 4 weeks ago. So she wasn't even there. It's ridiculous. But hey, guys, again, not a problem with it at all. Now, what has been the fallout? What's been the fallout? Let's see what's going on after this, guys. Let's go back to our old buddies at Valuetainment real quickly here, guys, and see what's been going on now. All right. This is what no one on television is talking about. What is going on right now? Okay. No spin, straight facts. Take it in. All right. Here we go.
Silicon Valley and Credit Suisse, because a bunch of stuff came out just yesterday. You saw their stock at the beginning. The Dow was down 600, and then it ended up with a couple hundred down. What's going on with the markets right now?
Well, speaking of utopia, no, overnight, it's very interesting. This can be summed up in one chart. Do you have the chart that came from Apollo? So this is a very interesting chart that comes out assessing the balance sheet risk of the banks. Yeah, can you pop that up a little? Mm-hmm. And the arrow up there that's toward the left side is pointing to Silicon Valley Bank.
Wow.
Everything to the right of Silicon Valley Bank is actually more risky and slightly worse off than the Silicon Valley Bank balance sheet was.
Good Lord.
And then if you go all the way to the left, you've got at a score of 15 JP Morgan showing strength, prudence, and
these are all the banks.
Probably, the utopia banking experience there because it's risky. So what overnight has happened is that there is the realization that there is a lot of risk at a lot of banks.
Wow.
That's happened overnight.
Wow.
Right before the market closed, First Republic, remember they said that was the other bank everybody was concerned about. It has been downgraded and officially given the rating as junk.
Wow.
And Moody's came out and said, you're not pinning this on us. We're just going to say the whole sector is downgraded.
Wow.
And they downgraded the entire sector to like this questionable status. And so right now, literally, Pat, what we are waiting for the markets to show us market response to the stocks of the public banks and waiting for the other shoe to drop, because it's not just New York and it's not just SVB and it's not just First Republic. It's Credit Suisse yesterday morning coming out saying with the stock price of $2.44. So they're down the street from being delisted. I mean, they're not far away. I think it's 90 cents for so many days and something. They would be, put on a suspension and then ultimately delisted.
Again,
so what's going on is there's a huge amount of uncertainty, Pat, and there's big amount of uncertainty that no one can have an opinion on. Can I show you a poll real fast?
Of course.
About what is the Fed going to do in the face of all this madness? Yeah. And I put a poll on Twitter yesterday. So here's 326 votes. Do you think, and I
notice, guys, everyone's pointing to the Fed, and that's fine. What does the Fed do? They print. So is what Robert's saying true? Let's listen.
Asked a very just sensible, straightforward question. Okay, consumer price index shows inflation's about 6.5 for the year. Still a problem. and with the SVB collapse, what do you think Jerome Powell will do with interest rates when he announces them next week on the 21st, 22nd? Half a point as expected, a quarter point and be a little more gentle, or 0 and then revisit it on May 2nd, which is the next scheduled official meeting of the Fed. Look how close it was. 41% said he's going to, just do a quarter point, and 32% said a half a point, 26%.
Wow.
For most of the life of the poll, and this is 326 votes, and these are public people, not a bunch of banking industry folks, it stayed pretty even, which means everybody actually wasn't very sure. So we're going to find out next week, and we're watching and waiting each day, along with getting more realization, Pat, that a lot of banks have very weak balance sheets right now.
Very weak balance sheets.
There's a lot of turmoil in the sector.
But by the way, when's the last time Moody's downgraded an entire sector the way they just did?
That's
specifically
crazy.
banking, right?
No, and I'm not exaggerating.
banking-
That is what they
banking
did
that's
yesterday
crazy
before the
to me.
market closed. They said, okay, we're
Got rid of
downgrading the sector.
The
When's the
whole
last time-
sector.
Is that have you heard of that
The whole sector, guys. Good Lord.
before? Was it like because it's 9/11 wasn't a sector, like it wasn't like
Right,
you're gonna, 9/11 was. So it makes you think. Yesterday, I'm talking to the folks at Morgan Stanley. I'm like, so what's going on? He says, look, you can't raise 450 bibs in 12 months and not expect these banks to go through what they're going through right now. So, but here's the question.
Completely.
The question becomes the following. Okay, Janet Yellen, you guys build out those, however many people at Silicon Valley Bank with above $250,000 FDIC. So we're not bailing out Silicon Valley Bank. We're bailing out the depositors is what we're doing. Okay, fine. No problem.
Bank's
Noble
going to
move.
fail, going to get sold, but we're helping the people.
Okay, no problem. Great. How many more can you handle?
That's
One
the
more?
question right there.
5 more?
It's dominoes.
10 more?
Wow.
20
That's
more?
the question
Like,
right there.
I had a friend of mine. He started making, he was the top interior designer in Hollywood. He was making 1.6 every year, and I'm his advisor. He's sitting with me. I'm doing a needs analysis.
Before we go there, guys, here we go. I want you guys to see this real fast. That's a good question. The question you just asked is how many more banks, the domino effect, the fallout. How many more banks can I do this with? Well, guys, let's look at this real quickly here, guys. Let's go ahead and see how much, if I can show it real quickly. Let's see if I can get it. Here we go. Show you this real fast. Make me a little bigger here. Guys, look at this. I want you guys to see the how much the FDIC has on their balance sheet. The FDIC only has $125 billion securing $9.9 trillion. That's only 1.26%. That's ridiculous. They're going to do this once or twice. With the domino effect, what's going to happen? That's why he's saying what he's actually saying. I mean, guys, this could get real. 1.26% is how much you actually have in cash on hand, securing 9.9 trillion. A little downtick is insolvent. This smells a lot like 2008, right? A ton, guys, a ton. But they can't stop printing. They cannot stop printing, guys. This is crazy town. What's going on? All right, guys, come back to me real fast, guys. Here's my reaction to all of this. Number one, Silicon Valley Bank knew what they were doing the whole time. Number two, so did the C-suites, executives for that bank. And also, I believe the media knew what was going on as far as CNBC. That's my opinion. I believe it because you're pushing something. Well, and what Kramer was prescribing didn't make any fiscal sense. Didn't make any sense at all. Period. All right. Number two, they invested in risky stuff. They bought bonds at a low interest yield. All right. Not expecting for the Fed actually they did expect it because the Fed said they were going to do this. Right. They said they were going to do it. They were going to raise the rates. So they should have been exiting these investments, those bonds, earlier before the Fed began saying this, but they didn't do that though. Why would I buy your bond at 2% when I could buy a bond at 5 or 6%? Right? Didn't make any sense. There's no arbitrage there. But when they were forced to actually sell, those unrealized losses have to be shown as realized losses now. That's when the depositors got really freaked out and began getting their money out, and then this happens. Right? Number 2, President Biden and the administration, the taxpayers did pay for this. I know what a lot of people are going to say. They're going to say, well, no, the banks are going to pay these fees. They're going to pay these fees going in. I can understand with the fees, but this is business 101. What do businesses do with fees? They pass them down to consumers. They don't pay the fees. They pass them to the consumers. So the consumers are going to get paid. How do banks make money? Off of interest and fees. Hello. It's real simple. This was the bailout, and you're paying for it. Number 3, we just saw right here, guys. We just saw right here. We're seeing this right here. $125 billion securing $9.9 trillion. That's only 1.26%. Guys, there's no way in hell they have enough money to cover all this. So what's going to make up that delta there, guys? Printing money. Robert was right. They're going to print the money. This is not hard to understand. They're going to print it. They can't stop printing. They can't stop. It's going to happen, which is going to cause more inflation, which means the cost of living is going up. Understand that. Guys, I'm putting this here, guys. So if anyone wants to schedule a wealth management strategy call, because I know there's a lot of uneasiness there, myself and my staff, we're available. Scan the QR code. If you're on Instagram or any other platform, you may have to go to YouTube or your Rumble to get this code. But guys, we're standing ready to help you guys out, to help you reason and understand where you're currently at. All right, guys? So I digress. But that's what's really going on, guys. To be honest with you, there was a lot of bad decisions, and I kind of agree with Kevin O'Leary. Kevin O'Leary was actually saying, number one, he was saying that what President Biden did was he actually uncapped everything. He was right, but FDIC, he was right. So is this heading toward the nationalization of the banks? Potentially, because what happened is JP Morgan Chase, as well as Bank of America actually made $2 billion, not in active investing in the market. People are taking their money out of said bank and depositing into Bank of America. Right, and JP Morgan Chase made $15 billion during this time frame. People just basically taking their money out of their accounts at one bank and put it into JP Morgan Chase. Jamie Dimon bought $26 billion worth of stock in Chase because he knew what was coming. So what's happening is fear, and also the interest rates beginning to squeeze those regional and small banks now. People are beginning to withdraw their money out and then deposit into these big four banks. So what's happening is this is squeezing the regional as well as smaller banks, and it's assisting the big banks. So what Kevin O'Leary is saying is a possibility. I got to keep it 100 with you guys. All right. So guys, what's your counter move? Well, simple. I always say, got my 3 points, guys. Peep it, sweep it, and keep it. Real simple, guys. Peep it. Examine your current situation, right? All right. What's it look like? Well, what environment are your resources located in right now? Remember, Robert talked about the 401k, the IRA, Roth IRA, 403b. He's called those the pension funds. They actually buy a lot of bonds. The bond market is getting hosed right now. So he was concerned about the pension funds. He's actually right, guys. He is right. He's 100% right. If your money is located in a 401k, IRA, Roth IRA, 403b, or any type of TSP, or any type of retirement pension fund, it's probably wise for you to begin to look at where a different place to park that money at. Right? What would I advise? I would advise a life insurance. I would advise me specifically a life insurance type of environment because it gives you the necessary protection you need. You can earn yield as well, tax free, right? And also your principal is protected because it's just mirroring the S&P 500. You have a floor of 0, ceiling of 10, right? And it really depends on the type of insurance product that you pick. I just described an IUL scenario, right? That's what I would do. I would take my money out of those low velocity, velocity or yield accounts and put them into a different account, a life insurance environment, right? All right. That's what I would kind of do there. All right. Number 2, I would advise, and let me go back here. And guys, if you need any assistance there, guys, again, schedule a wealth manager call with us, guys. We'll help you out. All right. Let's go back here. Number 2. All right. Invite in the wise counsel, guys. You don't know everything. I don't either. That's why we need wise counsel. What I mean by that, what's it look like? It's time for you to unlearn what you know about money. All right? It's time for you to unlearn what you know about money. It's about that time, guys. What you know about money got you where you are right now. It's time for you to be coachable. Inviting that wise counsel and unlearn some disciplines that have gotten you where you are right now. Okay? All right? I mean that respectfully. All right? It's time for you to unlearn what you know about money and be coachable. Inviting that wise counsel. All right? Invite that in. It's okay. Have those tough conversations if you want solutions, right? Number 3, keep it. Continue to press toward the mark of excellence. Excellence is the standard. The standard is excellence. Not average, not mediocrity, excellence. All right? What's it look like? Invest in hard assets. What are those assets? Real estate, gold, silver. I'm going to say life insurance is a good foundation as well also. I'm going to say that again. Invest in hard assets, guys. Things that can cushion you from hyperinflation and deflation. That makes some sense. Those cushion things, right? Because your cost of living is going to go up because the Fed is going to continue to print. They have to. We just saw how much money that the FDIC actually have. They've used that money already on those 2 banks, on Silicon Valley Bank and Signature Bank. That money's gone. They've used it. It's gone. So what's the other money coming from? They're going to print it. Simple. Well, guys, that's all I have for today, man. Again, I gotta say, guys, if you're gonna be of any assistance, guys, feel free to reach out to us. That's it, guys. We're here just to give wise counsel if needed. Everybody's solution is different. It should be customized to you guys. If we can point you in the right direction, reach out to myself and my staff. We help you out as much as we can, guys. But guys, thank you for your time. And also, guys, before I get up this thing, man, hey man, we got some merch coming out right now, guys. This is the bag man hoodie. Mine is on its way, so I'm gonna have mine on next time as well. And also, we have it in t-shirt form as well, guys. We also have the one in green as well, guys. You see that thing because it's me looking fresh, cold, clean, guys. But yeah, guys, that's all I had for today, man. Thank you for your time. Oh, my bad. Sorry about that. And also, guys, on Friday, guys, somewhere in the middle was Suni and Mo. Man, they are so cool. Love those girls. They're killing it over there, man. Here's a little taste of what they do, guys. Here we go.
Now we're about to get going down. Facts on facts on facts. Hello.
Guys, that is somewhere in the middle with Suni and Mo. They air every Friday at 9 p.m. Eastern Standard Time, 8 p.m. CST. Check them out, guys. They're on all platforms. Forgive me, guys. I know I was not as energetic as I normally am. Still getting over a little bit of a sickness, but I still, again, look better than you. Now, you know I end it every time we get off this thing. Now, before you leave, and while you can, you see that thing, take that picture, and give it to your grandma now. Now, holla at your partner, guys. Thank you so much for your time. God bless, guys.